Hi everyone, Maria here, and welcome to Season 1 of Gut Talks, GGUTT, a podcast focusing on business and tech for good, experience design, and gut feelings. What does the traditional VC model and traditional angel model do wrong or can do better, in your opinion?
So the tradition, actually, one of the things both traditional models do well is they don't understand diversification in math. Every angel in VC feels that they can look at a company and through whatever combination of analysis and gut feeling, they can determine who is going to succeed in the future and who isn't. Through having run Founder Institute programs where I saw tens of entrepreneurs, I know that sometimes the ones I succeeded were exactly the ones I thought would. And sometimes they're the ones I was sure were going to fail who actually did succeed. So I've realized the humility of, I can't pick them. And if you step back, and in fact, the math is that 2 out of 3 venture capital deals fail. 1 out of 25, so 4% of venture capital deals will give you 10 times your money back or more. Now, every VC and angel sits there and says, I am special, I am different, I can recognize that 1 in 25, and I'm only going to invest in them. And they build a whole portfolio of companies they think are home runs, and then actually the end result is 2 out of 3 fail, and 1 out of 25 is a home run. So we looked at this and said, well, look, it's a statistics game. If you accept that that sort of everyone on average is about equally able to recognize winners, then okay, so if you have 25 deals, you may or may not have 1 home run. If you have 50 deals, you probably have a home run. And if you start going up into 100 and 150, and then there's probabilities, your probability is actually 1.5% of getting a company which is 20 times or better. So then you say, okay, if there's a 1.5% to 20 times or better, then I want to have 150 companies in my portfolio to be sure you have at least 20 times in there. And so yeah, lo and behold, Loyal VC has 150 companies in our portfolio today. Well, it's just about 150 right now. I think it's 148. So yeah, we are
You're getting there.
Very aware of that math. And we're very aware of that math, which is we can't pick winners. We don't have a perfect crystal ball, which tells us the future. And I'll give you one specific example. We invested in a company in November of 2019. The founder came to us and he said, the medical establishment does not know how to treat viral diseases. And normally, 2 things are right. Either the founder is right or the medical establishment is right. Don't bet against the medical establishment. However, we have a network of over 300 advisors. One of them's sort of top doctor down in the US. And we got this doctor to do a diligence call with him before we invested. And the doctor got back off the call and he said, look, the guy is completely crazy. He's absolutely right. This is not at all how one should treat viral diseases. But I can't prove he's wrong. What he says is possible. I don't think he's right, but it's possible. So we funded this company. In November, he was saying, look, viral diseases don't kill you. It's how the body's immune system reacts. There's these things called cytokine storms. And those of us who have lived through COVID-19 in the past little while know all about this now. But initially, to make that investment in November of 2019 was very brave because you are sitting there saying, here's someone who tells me viral diseases are treated differently. And by the way, nobody cares about viral diseases. He'd spent all this time treating HIV, but come on, it's not a big market, et cetera, et cetera. There's a lot of reasons to say no to it. But if you sort of take some chances like that, you position yourself for potential mega upsides. There's one, I don't know, one thing I love looking at is Bessemer Ventures has their anti-portfolio, and it's the companies they said no, a list selection of companies they said no to and why. And that list of companies they very rationally said no to includes Apple, eBay, Google, Facebook, Tesla.
Wow. Okay.
And when you look at the reasons, like Facebook, they said no. They said, hey, kid, have you never heard of Friendster? It's over, give up. So this is all for me, the humility of, as a venture investor, you cannot predict the future. It's a numbers game.
Yeah, that's, I mean, I would be curious to know about this startup you invested in 2019. How are they doing?
It's doing extremely well right now. The very short answer is they're doing extremely well. They do testing of blood so that you can actually tell how people's immune system is reacting, and you can treat each person individually based on what their body is doing, rather than trying to treat them with a generic sort of, here's the formula you follow. If you understood how their immune system is reacting and could predict things like a cytokine storm before it occurs, you can get much better at it. And of course, look, in the past years, our medical treatment has gotten better and better and better for COVID-19. They're just a test which hopefully will be on the market within sort of 4-ish to 6-ish months, which will make it even better and easier to treat this disease.
Okay, I think we need to connect offline on that one, because actually for whoever's listening to this, episode 3 that I released with Imovid and Pieter Law, it's just because we're talking about healthcare and testing here. It would be an interesting episode to listen to. It's just about how they're building an ecosystem to reopen the economy. So this startup we invested in can be something part of this ecosystem. Maybe we need to explore further, but it's good stuff. No, that's interesting. It's about having foresight without even knowing about it. And then less than a year later, what happened, like COVID, actually in China, it was before that. So anyway, since we mentioned COVID, that's a question I want to ask you. It's just kind of a recurring one, because obviously COVID affected many things, right? And everyone. So did it accelerate your investments? Did it take them into another direction? Did it make you focus more on impact, sustainability, responsible ventures? Did it allow you to raise more money? I don't know.
So COVID, overall, COVID has been excellent for our portfolio, I would say. We've had very good financial results over the past we've had very good financial results since we launched. So our fund is very clearly a top quartile venture fund, and we actually do staged investing. So our stage 1 investments are very diversified, based on the references from the network, not knowing and not having a view of how things are going to turn out. We then do follow-on stage 2 investments, which are $200,000 each in size. And we have a return on those $200,000 exits, which is investments, which is well above 40% so far. So we're doing magnificently. What we found with COVID, just on the return side, is a third of our portfolio, COVID was amazing because it's accelerated the adoption of technology by about 5 years. A lot of tech markets, they sort of, you can just see this step change where they've gone ahead. We have a company out of Singapore, which does software for restaurants, which allows you to see the menu, order, and pay from your own mobile phone. And then the only thing and you just sort of scan something on the table, you use your mobile phone to do everything. You walk out when you're done, and the only thing the waiter needs to do is bring you the food. Before COVID, the restaurants were saying, well, I don't want to use this. My waiters are complaining. I have to lay off waiters. Nobody wants to do this. After COVID, it's like, oh, people don't need to touch a menu, because restaurants by law had to throw out menus after each guest, which by the way is horrible for the environment too. But the concept of the restaurant could just have their menu show up on people's handsets was considered a wonderful thing. So, and now their vision of people eat, relax, walk out the door when you're done without having to wait for the bill is just, this vision is being adopted by restaurants now, where it was unthinkable for it to be adopted before COVID. People just didn't want to change how they operated. So that's a third of our companies. A third of our companies, COVID made no difference whatsoever. They continue running. It's sort of whatever they were doing, their business continues as before. And a third of our businesses, one of those businesses, for instance, is a company which does software for baby monitors to allow the baby monitor to recognize whether the baby needs their diaper changed or they need to be fed. And this is software they've licensed off to a big manufacturer. And guess what? People are still having babies and they're still buying baby monitors, and that business is unchanged. And then we have about a third of our companies where COVID was a big problem. We have a company that does software for hotel chains. The hotel chains love the software. They want to keep the software, but they were sitting there saying, we can't pay for the software right now because we have no revenues coming in. So they have really struggled during this COVID period. So the nice thing about our investment process is we invest in people based on how they perform, not how we think they're going to perform. And we react to businesses which are suddenly taking off because the market has changed by giving them more money. So, and they do well. So that's why we get these good returns.
Cool, because giving those examples actually show how diversified your portfolio is, because this is what you kind of preach as well and say, this is what you need to do.